Good weekend, all. Ira Epstein, and here we are on Friday. This is the 24th of February, 2023. And we're sitting here now on weekend, and that means we're going to look at the weekend edition of our charts on the financial markets and futures primarily. So other than the metals, we're going to cover just about everything else. A lot of people, by the way, ask me, Ira, why don't I cover some of the grains on my YouTube? No, I cover them here. I cover the meat markets here. I cover the soft commodities here. So it's in different areas in my morning subscriber videos that I do them. As for these, no, I'm not going to do them on the YouTube. Market audience is smaller. That is the reason. The paid subscribers get all that and a heck of a lot more. All right. So this is the week where if you don't understand enhanced Bollinger Band, take my course. Not a sales pitch. This is what it's all about. If you don't understand the working of Bollinger Bands, the idea that the natural resistance and the support set off by the algorithm that says the market will trade within those bands 95% of the time, you want to learn and pay attention. And you would have been out of harm's way to a large degree this week. Now, the event that happened today is the one that I prep you for all the time. You'll see me dance my song where I say, I'm not going to stand on a train track and a bullet train's coming and I think I can move quick enough to get out of the market's way. Even if I think I know what the reaction will be, what makes you think it'll be that way is the first problem. Number two, the algorithms take over the trade right when these big reports come out. And the market lets you know if it's going to be a big report. We knew the PCE index was going to be an event. Why? Because the Fed has told us it's one of their favorite indexes. Now, every other report we've seen, and this economy is fighting, is that we're getting very strong data. Even today's home sales that came out, the supply of homes dropped. I would have thought with mortgages 6.5%, 7% that you can't sell them. It's the exact opposite that happened. So the strength in the economy is the weakness of the stock market right now. The weakness of the stock market is creating strength in its own way because the economic's so good in the dollar. The strong dollar is weighing on other goods. It's all tied together. The result today was the report. I've highlighted for you what your eyes should go to. This was the personal income spending and PCE index. The January index, the December was up 1/10, January went up 6/10. 6 times is great. It's the exact opposite what the Fed wants. The Fed is saying, hey, we keep raising interest rates, there's a lag effect, but there's a cumulative effect. And that cumulative effect that you saw already supposedly in housing, where housing prices will come down, people can't buy as many. Okay, that's the theory. Well, if that goes down, prices go down and inflation gets under control. What's happened isn't that just yet. Not saying it's not going to happen. I'm betting on the Fed, by the way. It will happen in time. The other one was the year over year. This shook the market. Instead of the market, you can get month-to-month variations, but on a year-over-year, you're up 4/10 more. This is all the wrong way. So the market's saying to itself, at first we had the naysayers, and I've called them that for you all the way through. The naysayers saying, the Fed's going to have trouble. Come June, we'll be looking, they'll be rolling themselves back very quickly, and by the last quarter of the year, they'll pivot to the downside. These reports are saying, I think you better adjust your thinking until we get to the point of inflection where we start rolling back down. You keep pushing that calendar date out. What the Fed doesn't want to do is tip the economy over. It wants to nudge it to the downside. Nudging is not tipping it over. Will they go to 50 basis points? Well, there's the hawks arguing it. I have my doubts. And the reason is they're waiting for the cumulative impact. They don't need to get it to the point so fast then. I think it's gone longer than they thought, but I bet you to a person they're saying to themselves, no, the cumulative impact is there. We're starting to see fringe signs of it. We don't want to go crazy and then just send it down. That's what I'll bet that they keep saying, and I'm not saying they're wrong. I'm saying that's what I think they'll do. So I think they're going to stick at this point with 25-point hikes unless between now and March 22nd, we get more economic data that is just powerful as can be, and they go, nah, we really got to slow it down. It would take major CPI and labor reports to do that. It could happen. What you do know is you're getting a rate hike in March. What you do know is you're going to get one in May. After that, we have to see what the data does. It's starting to edge that June will have one as well. What I think you're doing is losing the ability to take rates down later this year. Now, the next thing that's happening, if you don't understand these Bollinger Bands, you got a problem, because they have been the setup that has saved traders and telling them where to come out and put you sideways. I had a heck of a week trying to find trades this week. It was difficult. The only trade we had been short the S&P for my paid subscribers. They covered their shorts this week, and I'm sitting there twiddling my thumbs looking for trades. Well, I've learned you let the market come to you, you don't go to the market. And that's basically what we've been doing. If you look at the E-mini S&P on a monthly chart, all we've been doing is trying to get up to that number of 4180 and can't do it. So the bearish bias for the bigger picture is there. I define bias if the market is under a key moving average, the bias is down. If it's over it, the bias is up. In 2022, the bias shifted. You see it. It has never come back. And if you think about the market as a whole, okay, to a degree, that's been pretty darn true. You then go to the weekly chart, and we have been talking that I think the market is going to come back to the 18-week moving average of closes. Ta-da! I'm getting it right now. This week's low, 39.47. You close 39.75, and that number's 39.79. So it was hard. I kept saying I think it's going to happen, and it did happen. Victory lap. Next, you look at the market as it's been coming up here. The pattern is not tradable on the weekly chart. What does he mean by that? Well, what's he talking to me? Well, you got a higher high and a lower low. The brown line is a swing line. It's set up from 5 different rules. I teach it all in my charting course, and I make you do it in the course by hand, and then I give you the indicator. That way you know it. It's based on either lower lows from the prior bar on the chart. A lower low, a higher low, an inside pattern, or an outside pattern where you took out the prior bar's high and low and closed down, or took out the prior bar's higher, high, higher and low and closed higher, an outside day or outside week up. In this pattern, you got a higher high, lower low. There's no trend. You had a vertical move. We all see that. Do you remember December 30th? We started going up that week. We went all the way up into the first week of February, and then the market started petering out, and this is what you've done. You went from 42.08, and suddenly you're back down in the market 230 points, going, what the heck? How did that happen? How fast did that take place? Well, one of the reasons it happened, in part, is the market went up looking for resistance, and it got up very close to it right here. Let me just show you. The 100-week, you're always putting key moving averages. And what are the key? It's what the public wants the key to be. And public can be the institutional trader and the John Doe trader, but it's the popular ones. People are always talking the 50, the 100, the 200 day. Others will talk a 20-week average, 18-week, whatever they want to do. I'm the 18, some are 20, I've seen 21s. They're in that zone. But here the market gets up to 42.0850. The 100-week is 42.09 and a quarter. You're in the ballpark zone. Market starts backing off like that. And it goes back to neutral. What's the home field where you run? The bombs are falling all around you. You're in Ukraine. It's your shelter. Well, the shelter is the 18-week average of closes. It's the neutral number. But there's another number you always have to pay attention to. This is what they build the hotels in Vegas on. The hotels in Vegas are built on the sucker traders, right? You see them in every casino. They have their drinks. They're not playing the odds. They're having a good time. And you don't go to Vegas to win. You go to Vegas for the good time, right? The pros, the guys that's the real pros, he's not in the casino that you see. He's in private games or he's in the big spender clubs. He doesn't want some guy sitting at a table or doing whatever and disturbing the pattern of the game that he's playing. It's too much money at stake. Makes sense. Who's going to hit on a 17 in blackjack? Yet you get these characters that'll do it, right? So they don't want to do that. Well, that's the same here. If you hit a Bollinger Band, what are the odds of staying over it? 5% of the time. Now, I believe that there are professionals out there that say, well, that's if you hit it. But what if I get within 0.5% or 1%? The public's saying if it hits it, maybe I want to be in front of that a little bit. They're not going to be behind it. They might go in front of it. So you get a little bit of variance. But the theory is, if you get there, some money's going to come off the table from what I teach and what I believe. It's that simple. You don't have to agree with me. That's what I teach and that's what I believe. I then look at it in the combination of momentum. Is the market locked into a bull or a bear trend? Is it overbought or oversold? If the market is just overbought, definition, you don't have both the red and the blue numbers going sideways over 80. Didn't do that. And you're overbought, I say the pros are coming out of the market. They'll deploy money into another market, whatever. What makes you think you always got to trade the S&P? There's no rule that says that. You're looking for patterns. Take the name off the chart. When I teach my charting course, you know that I take the names off of them? I'm redoing the whole course again this year. I do it once every, I don't know how many years. I wait about 5-6 years or sometimes more. Then I redo them. But I don't want the name on the chart sometimes. I'll bring it back later in the course. I don't want you to get, oh, I know it was going up or down. I'm not interested in that. I want you to learn the pattern. The pattern here is simple. You go up to a Bollinger Band. You're looking, is it overbought, oversold? Well, obviously, is it overbought or embedded if it's going up to it? If it goes down, is it oversold or embedded? Then out they go. Where's neutrality? Back here. Is the market trending? No, there's nothing to do in this market right now. In the Dow, I teach you in the bands, when they start narrowing in, be careful. What happens is you go into a churn now. You just go back and forth against that average. It's rare that you're going to break under it or over it. You need power to get away from it. And the big trends come after you've gone sideways for a while. Do you see this? This is where this break all occurred. You need the power in the market to gather. That's the key to it. In the NASDAQ, you went up, you hit the Bollinger Band. Go back and read the news at that point if you can. I don't know if you keep it. Everything was super bullish. We're going to go to 4,200 in the S&P. This market's going to keep going. The naysayers, the Fed is going to back off on everything. Go to your headlines. Well, now the market's coming back down. Those naysayers, if they're still holding those positions, they're under serious water. It doesn't look like it to you, but if you're using futures, remember the leverage is 10% you're putting down. That's a lot to be dropping from these, even the most recent high of 12,792, and you're sitting here 800 points lower in the market. It's expensive. I think you're going back to the 18-day average. The combination there is the 18 and the 200, and the game will be decided as it restructures itself. What you have here is a market that has bullish bias. I'm with the bulls on that because you're over the 18-week average, but you have a correction. You have a downtrend within that should carry to those numbers to look for and see what happens at that support level. The same identical thing taking place in the Russell. You got up, you're overbought, it's there. And when it's happening, guess what? You're the most bullish you've been, whereas the work is saying, no, that's not what you want to do. You want to be taking money off and deploy it elsewhere. You don't belong in that market any longer. In the 30-year bond, the trend is down. It started down not this week. The trend began down on the correction right here and under the 18-day average. The trend down, the bias down since you're under the 18-week, and momentum down. The risk would be back over here, that high, and potential could be the lower Bollinger Band. Now, there's window envelopes, and I don't show you all the numbers here, but there are some variations in it, and my subscribers get to see all these. And this is what you look like right now going home. What about the 10? It's identical, but the difference here, you're already oversold. So you got to be very careful. Can you reach down for that? You could, but you're in borrowed territory. And because you're nowhere near embedded, the pros are going to look like I said. They're looking right now, how do they take money off the table, not how do they press money on the short side. In the dollar index, Let me walk you through this, baby. It was so simple. Here is the market flirting. Is it going to get over the red line or not? And this was the week of the 10th. Last week, the market gets this close. You got a 30 reading. You're out of your embedded reading. These odds are strong. I wish I could tell you all the time it's going to go up to it. I can't. It's a vast majority. It's going to make a run at the closest main moving average. That's what I teach. I think it's going to get to the 18-week average of closes. Whoops, excuse me here. I know, like drama, right? This is what you did this week. Now, is the trend up now? It is. What's the risk? Getting under this low. That's it. It's had a, let's call it this way, a bearish bias that has now neutralized itself. Do you want to risk that amount of money? That's a whole different story, but the trend is up on the chart. In the euro, it's the flip-flop. You lost the bullish embedded reading right here, and when you did it, you fell back to the neutral point. This is what's taught in this course that I have for you. It's a simple course. You will take it over a weekend and you're going to go, wow, this is interesting. And you'll start applying it and you're going to say, very cool. Canadian dollar, trend down, bias down, momentum down. Now I'll be telling clients go short with stops over the most recent highs. I'm looking for the Bollinger Band. Japanese yen, I tried last night. If you're one of my subscribers to my full research, I was putting out sell signals last night. I waited to see the new nominee for the bank governor to talk, and he's as dovish as Mr. Kuroda. And I said, you got to go into it. Well, I missed the trade. It fell too much, and I wasn't willing to take the risk. But you're down 132 points for the week. It's a big break, nearly 2% in the market, and it still looks bearish to me. And now I don't think the market's got any ray of hope from him. I think he'll stay and hold the pattern for a while. He doesn't even take office till April. So you got another month of what it was and then what's coming. In Bitcoin, you got up to the combination of the 200-week average and the Bollinger Band. What do you do? This was last week. This week, you challenged it again. I think the market's very vulnerable up here, could pull back for no reason. Now, the differential, and that's what I'm plotting here, is the differential between WTI and Brent, just to see, is Brent under more demand than WTI? The wider the premium goes, the bigger the demand. That's typically what it is. And if you look at the market, we've had a bear market rally back to the 18-day average of closes that it keeps failing right at that number. Now, if it can close over these two numbers, 87.99 to 85.71, could get bullish again in the market, but you're in a resistance point. In WTI, you got to be able to close over the 18-day average, and then that's 79.52. The next resistance, 83.80. A bear market rally into the resistance of the 18-day average of closes. Now, in the gasoline, I prepped you 3 weeks ago, 2 weeks, I think it was 3 weeks ago, that I thought we were making a low back here. You can even say back there because it's weeks ago. It's probably this low, but I didn't think you'd go back to that one either, period. And I think you're going to fight a battle here looking for wherever the next shoe is. Eventually, what I expect to happen is the spring demand's going to hit. Now, it could hit a little early. Why? Part of it could be, I don't know if you're watching the news. I know you're going to tell me, Ira, we're having a blizzard in Los Angeles. We haven't seen that since the 60s. It's snow in Napa Valley everywhere. And what are you talking about? Well, there's also the cherry blossoms in Washington, D.C. have come out. I'm in Chicago. We're averaging 19 degrees higher in temperatures than we typically are at this time of year. And already the buds are coming out everywhere. So Mother Nature's probably 2 to 3 weeks now in front of herself. In other words, earlier than it normally is because of the warmth we've had. And you know that if you're watching natural gas and things of that nature. Is that going to get the summer driving and the spring driving a little bit early. I doubt it, but it could. So I pay attention to everything. I mean, you watch your news. Are you not hearing spring break is coming? Here's the prices. What are the kids going to do? Blah, blah, blah. Booking.com is saying, hey, we're finding people buying like mad right now. And they are through that, and they're buying their summer trips. So you know that there is going to be that demand for travel, be it airfare or cars. It is coming at you in a big way. As I said, in the Bollinger Bands, trading without them is like trading like this. You're crippling yourself. Please take a look at this, consider it. I think it'll help you with your ideas.